Hi guys, so today we'll be discussing SA 510 Initial Audit Engagements Opening Balances. Now in this essay, the title itself, the title Initial Audit Engagements Opening Balances, this title itself contains and is conveying a lot of meaning about what the standard is kind of trying to say. So if we try to understand this, the meaning of the title itself, that is going to help us a lot in understanding this standard. Now, the meaning of the standard, the title of the standard is split into two parts. If you see, it's got initial audit engagements and then it's got opening balances. Now, what is the meaning of initial audit engagements? Initial audit engagements can be two types of engagements. One is where the prior period was not audited. This means that nobody ever audited the prior period financial statements. The prior period financial statements are unaudited. Okay, so the first scenario is where the prior period financial statements have not been audited only. The second scenario is that the prior period financial statements were audited by a predecessor auditor. Now, what is the meaning of a predecessor auditor? Some other auditor who was there in the previous period. It has not been audited by the current period auditor. It has been audited by the previous period auditor, and that is an initial audit engagement. Either the previous period financial statements were not audited or they were audited by some other auditor in the previous period. These two scenarios comprise initial audit engagements. Now the next point is opening balances. What is the meaning of opening balances? Now see, in your financial statements we always have comparative numbers that we give in the balance sheet, in the P&L, in the cash flow, throughout the notes to accounts also. Always we have to give comparative amounts, that is the current period amounts or the current year amounts and the previous period or previous year amounts, right? Now this previous period or previous year amounts that we see in the financials, these are our opening balances. Now ideally when we are auditing for the current year, we do not audit the opening balances. We audit that the closing balances, that the current year balances, the current period balances are correct or not, because we assume that the previous period balances have already been audited in the last year, and that is why we only check if those numbers from the previous year financials have been brought forward correctly in the current year. That is the only kind of check we do. But what is the standard saying? That check is appropriate if we only have been the auditor in the last year. If we have been auditor in the last year, then we can place reliance because we know that we have performed the appropriate procedures in the last year to check that those last year's numbers were correct in the last year itself. But now since the auditor was somebody else, or maybe it was not audited only, so that is why we need to kind of perform our own procedures to check that the opening balances numbers are incorrect. Also, if you see the two scenarios, one scenario is where the previous year numbers have not been audited only, and one is where the previous year was audited by some other auditor. In these two scenarios also, if you see, the more kind of tricky or the more dangerous sort of scenario is where the auditor would need to perform more procedures would be a scenario where the previous year financial statements have not been audited at all. At least if it has been audited by someone else, you can place some kind of reliance that the other auditor who would be a member of ECAI would have done some kind of proper audit procedures. But in case it has not been audited at all, then you have to be more professionally skeptic. You will have to be more alert in kind of auditing those numbers. Okay, so with this background, let us just go forward in the standard. The first question is scope of SA 510. Now, SA 510 deals with the auditor's responsibilities related to opening balances when conducting an initial audit engagement. So, SA 510 is when you are going to responsibilities related to the opening balances in the financial statements when you are conducting an initial audit engagement. In addition to financial statement amounts, opening balances include matters requiring disclosures that existed at the beginning of the period, like contingencies and commitments. So see, they are saying that opening balances are not just limited to the last year numbers. It is also including, let us say in the previous year notes, we would have there would be some numbers which are appearing as contingent liabilities and commitments. So even those numbers are to be included in our opening balances audit. Opening balances is not just balance sheet, P&L and your cash flow numbers. No, it also includes the numbers that are appearing in notes like the contingencies and commitments note. Next, what is the objectives of the auditor as per SA 510? So there are two objectives: to obtain sufficient appropriate audit evidence if number 1, opening balances contain misstatements that materially affect the current period's financial statements. So what is the objective of the auditor is to check that the opening balance, if they contain any misstatement, because that would affect his current period financial statements. In the current period financial statements also, we are showing the opening numbers, correct? So those numbers would be wrong if he's just directly relying on the last year's numbers to be correct, but in fact they contain some misstatement, then it would be wrong on his part to just bring forward those numbers. He would have to correct those numbers and show the appropriate number in the current period financials for the previous year. Okay. Second point is appropriate accounting policies reflected in the opening balances have been consistently applied in the current period's financial statements, or changes, if any, are properly accounted, presented and disclosed as per applicable financial reporting framework. So opening balances is not just limiting itself to opening balances, the opening numbers, it is also encompassing accounting policies. Now what is it saying? Accounting policies should be consistently applied from one period to another. We know there are three fundamental principles of accounting, that is going concern, consistency and accrual. Consistency means that accounting policies and principles should be applied from one period to another consistently. They should be changed only if the change is improving the presentation of the financial statements, right? So over here also it is saying that we should ensure that the prior period accounting policies are consistently applied in the current period's financial statements also, and if there are any changes in these accounting policies, those changes should be properly accounted, presented and disclosed. We should ensure that that change is properly brought out. So if the management is changing some accounting policy for better presentation of data, then they should clearly mention that they have changed it, and the auditor should check that this change has been properly brought out in the financial statements. The financial statements contains a disclosure to that effect. Okay. Now the next answer is, what is an initial audit engagement? So this we discussed right in the start. It comprises of two scenarios. One, where the previous period financials were not audited, and second is where they were audited by a predecessor auditor. So let's just read this answer quickly. Initial audit engagement is an engagement in which either, point number 1, the financial statements for the previous period were not audited. Second, the financial statements for the previous period were audited by a predecessor, that is previous period auditor. Okay. So let's move on to the next answer since we've already finished this answer. Next, what are the audit procedures to be performed as per SA 510? Now this is an important question. Let us read. First, the auditor should read the most recent financial statements and the predecessor auditor's report thereon for information of opening balances. So what has the current period auditor to do? He has to read the most recent financial statements of the company and also read the auditor's report on those recent financial statements to gain more information about the opening balances. Second, the auditor shall obtain sufficient appropriate audit evidence whether opening balances contain misstatements that materially affect the current period's financial statements. So this is our objective 1. If you saw on top, objective number 1 is whether opening balances contain misstatements that materially affect the current period's financial statements. So how does he have to check this? The auditor shall obtain sufficient appropriate audit evidence whether opening balances contain misstatements that materially affect the current period's financial statements by A, determining whether prior period's closing balances have been correctly brought forward. So this is a very simple procedure. You will just take the current period financials and you will take the prior period signed financials and you will check that the closing balances of the previous period have been correctly brought forward in the current period. Second, determine whether opening balances reflect application of appropriate accounting policies. So you will also check that accounting policies are appropriate. Number 3, performing one or more of the following procedures. So there are 3 procedures. You can perform one or more. All are not compulsory. One or more you can do. If prior period financials were audited, use those copies. You should use those copies if they were audited. If they were unaudited, then you will only have to check if the opening balances are correct or not. Second, evaluating whether audit procedures performed in the current period provide evidence about opening balances. You should also see, so in the current period, you would have an opening balance, for at least for balance sheet captions, you will have opening balance, you will have current period transactions, closing balance. So you can check if the opening balances are correct or not. Third, perform specific audit procedures to obtain evidence on opening balances. So the second and third point is more relevant in a scenario where the previous period financials have not been audited only. So you would have to do some kind of procedures to get confidence that the opening balances are correct, because what has happened here, management has prepared the financials in the previous period, but nobody has checked if those numbers are actually giving a true and fair view of the entity's financial position as in that period or that year. So that is why you will have to check that those numbers are actually making sense or not. Point number 3, if the auditor obtains evidence that the opening balance contains misstatements that could affect the current period's financial statements materially, he shall perform appropriate additional audit procedures. So in this case, what is it saying? That we have performed our procedures on the opening balances and we have found that there is some misstatement, and that misstatement is materially affecting our current period financials. So in this case, what do? Do we directly qualify the opinion or give an adverse opinion? No. We have to first perform additional audit procedures. Then he shall communicate the misstatements to those charged with governance as per SA 450. SA 450 is effects of audit misstatements identified during the audit. So according to that SA, he should communicate the misstatements to those charged with governance. Fourth point, he shall obtain evidence whether accounting policies reflected in the opening balances have been consistently applied in current period, and changes, if any, are properly accounted, presented and disclosed. So this, if you saw, was the objective number 2 in our basic objectives. Appropriate accounting policies reflected have been consistently applied, and changes, if any, are properly accounted, presented and disclosed. So he should check that also. He should obtain evidence about whether that has been done properly. Fifth point, if prior period's audit report was modified. So this means maybe it was qualified, a disclaimer of opinion was given, or there was an adverse opinion, then the auditor shall evaluate its effect on the assessment of risk of material misstatements as per SA 315. So if the audit report of the previous period was modified, then it can impact your risk of material misstatement. Your ROMM can go higher. Okay. Now the next question is, how is the nature and extent of audit procedures to be performed on the opening balances to be determined? So what is the nature, what is the type of procedures that you should perform, and how much, what is the extent? Do you need to perform less procedures or more procedures? How will you determine that? How will you as an auditor determine that how many procedures and what kind of procedures do you need to perform on the opening balances? So let us see the answer. First point, the accounting policies followed by the entity. The accounting policies followed by the entity, that will give you an idea about what type and extent of audit procedures you need to perform. Also, like if the accounting policies are similar, like it has been consistently applied, then there shouldn't be much of a problem. But where it is being changed, you will have to question the management that why they felt like a certain accounting policy was appropriate last year, but the same is not appropriate in the current year. Like, why do they want to change an accounting policy? That will become an important question. Point number 2, the nature of accounting balances, classes of transactions and disclosures, and the risk of material misstatement in the current period. Now, account balances is your balance sheet captions, classes of transactions is your P&L accounts and disclosures. So your balance sheet, P&L accounts and your disclosures, and the risk of material misstatement. So what is the nature of your balance sheet captions? Some captions may be kind of more material, and that is why the opening balances in those captions, they may be more susceptible to error or fraud in the previous period. The risk of material misstatement could also be higher. So that is also going to determine what kind of procedures you need to perform on the opening balances. See, what is this point saying? The nature of account balances, classes of transactions and disclosures, and the risk of material misstatement in the current period. Now, some disclosures may only be giving sort of information, so those may not be very important, but disclosures like commitments, contingent liabilities and commitments, that is giving a lot of information, important information, because contingent liabilities and commitments is something that tomorrow could become a liability, a potential liability of the entity on the happening or non-happening of a certain event. So that is why it is very important to check those disclosures. Point number 3, the significance of opening balances in the current period. So you will also have to determine how significant are the opening balances. Now, it could have happened that the last year's financials have not been audited because the entity was it was a new entity which was started in the previous year, and it was hardly like operating for 1 month. Then the opening balances would not be very significant. But let us say it was operating for all 12 months and a lot of transactions have happened, in all the accounts, a lot of transactions have happened, a lot of business has happened, then the significance would go up much higher. Point number 4, whether the prior period financial statements were audited and was the audit report modified. So again, two parts here, whether the prior period financial statements were audited. If it was audited, then you will perform significantly lesser procedures. But where it was not audited, you will have to do quite a lot of procedures. And was the audit report modified? So in the case where it was audited but the report was modified, again you will have to do more procedures. Even though it was audited, but since the report was modified, you will still have to do a lot more procedures. Next, audit conclusions and reporting. So what are the audit conclusions that you will draw and how will you report on these? If the auditor is unable to obtain sufficient appropriate audit evidence about opening balances, he shall express a qualified or disclaimer of opinion as per SA 705. Understand, you can't give an adverse opinion. Adverse opinion is only when you have obtained sufficient appropriate audit evidence that the misstatements are both material and pervasive. Since here you are unable to obtain sufficient appropriate audit evidence, you can only give a qualified or a disclaimer of opinion. When will you give a qualified? When you feel the misstatements are material but not pervasive. When will you give a disclaimer? When you feel the misstatements are both material and pervasive. In both cases, you have been unable to obtain sufficient appropriate audit evidence. That is very, very important. Point number 2, if the auditor concludes that opening balances contain a misstatement that materially affects the current period financial statements. So in the first case, they are kind of talking of a situation where you have not been able to obtain only evidence. In the second case, they are saying that we have been able to obtain evidence, and after obtaining evidence, we have concluded that a misstatement is a misstatement is present in the financials, which is materially affecting my current period financial statements. So in that case, you will have to express a qualified or adverse opinion. Why? Because qualified opinion is when you have obtained evidence or not obtained evidence, but you feel misstatements are material but not pervasive. And adverse opinion is when you have obtained evidence and feel that misstatements are both material and pervasive. So accordingly, understand the difference between point number 1 and 2. In point number 1, we will give a qualified or disclaimer. In point number 2, we will give a qualified or adverse opinion. Third point, if the auditor concludes that accounting policies are not consistently applied or changes are not appropriately accounted, presented or disclosed, he shall express a qualified or adverse opinion as per SA 705. Again, if accounting policies have not been consistently applied or changes have not been adequately presented, accounted, disclosed, again then you will give a qualified or adverse opinion. Point number 4, if prior period's audit reports was modified, which remains relevant in the current period also, he shall express again a modified opinion as per SA 705. So the prior period auditor had expressed modification in the previous period, and that modification is still remaining relevant in the current period. You will give an SA 705 modified report. So that is it about SA 510. That completes our discussion on SA 510, and this is the full discussion, the full video on SA 510. If you want to download these notes, you can go to my Telegram channel. The username is CA Newton Lobo. Thank you to everyone who has subscribed my Telegram channel as well as my YouTube channel. In case you haven't, please do subscribe my YouTube channel and hit the bell icon to receive notifications. Thank you for watching this video and see you in my next video. Bye.